The Subcommittee on Housing and Insurance will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This long-awaited, much-anticipated hearing is entitled Factors Influencing the High Cost of Insurance for Consumers. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Today, the subcommittee will hold a hearing to discuss factors influencing the high cost of insurance facing consumers across the country. It is unfortunately a topic that both families and businesses are grappling with on top of the already steep cost of inflation and interest rate increases. We welcome today the testimony of our distinguished panel of witnesses, each of whom can address the cost and availability of insurance from several different perspectives. Specifically, I'd like to welcome Mr. Joseph Petrelli, who runs Demotech Incorporated, which is an independent insurance rating agency out of Dublin, Ohio. Given his decades of experience in the insurance industry, Joe has a unique perspective on challenges facing the insurance markets at this time. I look forward to hearing the insights of Joe and all of the rest of our witnesses. And this hearing comes at a critical time as consumers are facing record-high property and casualty insurance bills. Homeowners insurance costs are surging in many areas, with Americans paying between $1,500 and $2,500 a year on average. But many communities outside of this range have seen premiums increase by multiples of what they had paid in previous years. In addition, this year, the price of commercial property premiums experienced the largest single-year increase in over 20 years. Such costs are untenable for many, forcing homeowners to move to areas with less expensive coverage and pushing up prices for rent in commercial properties at a time when housing costs are at record highs. Meanwhile, losses for insurers are going up. Companies are paying out 104% in claims for every premium dollar they've taken in thus far in 2023. That would be 4% more than what they're bringing in. Add to that the growing market risk stemming from widespread lawsuit abuse from trial attorneys who are now spending hundreds of thousands of dollars each month on paid keyword searches, keyword search results. Those results are designed to target recent disaster victims and other insurance claimants and trick them into filing frivolous lawsuits. More and more, it seems that the insurance industry is at a tipping point where the risks of providing insurance are making the cost of insurance unsustainable even in the best regulatory environments and shaping our development, which is why it's so problematic when you have officials who ought to know better making bad and politically motivated decisions that add cost and decrease availability for insurance. We have seen that often in the California market, for example, the subject of 2 committee hearings in the last year where the imposition of ESG mandates have prevented insurers from charging actuarially sound rates or using modern modeling tools to manage wildfire risk. We've also seen with the Federal Insurance Office, a federal non-regulatory entity that is supposed to monitor the industry to help actual regulators make better choices. Instead, we've seen the Biden administration abuse FIO and turn it into a politically charged advocate for the Biden administration's social agenda. FIO is attempting to bypass state insurance commissioners and add massive new costs onto policyholders' bills through an unprecedented mandatory climate data call. In fact, this week, FIO has made clear that they are moving forward with this misguided effort despite widespread blowback. As I said in a March letter to FIO, that it's not just wrong, it also raises real questions about FIO's continued mission creep, leading to multiple bills being introduced to rein in this spiraling, out-of-control office. All of which brings us to the fundamental point here. Insurance has been, and should remain a state-regulated product, free from the involvement and clutches of meddling federal bureaucrats. Support for the longstanding principles of the McCarran-Ferguson Act is something that every member of this committee should stand by and affirm as the best way to protect policyholders and create healthy, functioning markets that represent the differences in our diverse states. I hope everyone here will show support for that ideal today, and I yield back the balance of my time. The chair now recognizes the ranking member of the Subcommittee on Housing and Insurance, the gentleman from Missouri, Representative Cleaver, for 5 minutes for an opening statement.
Thank you, Mr. Chairman. If I could indulge the committee just for a second, I wanted to mention that Mr. Frank Nutter, who's been in front of this committee many times. I've been on the committee 19 years, almost 19 years, and over that 19-year period he's been here, it seems like every other Thursday. But he is going to retire just because he wants to be happy. It's selfish. He just wants to enjoy himself. And I just wanted to use this opportunity to say thank you for all of the times you appeared before this committee. Thank you very much. Like most Americans, the people in my congressional district want to go to work, build meaningful wealth, and provide for their safety and security of their families. Access to affordable insurance is central to that. Americans look to insurance to protect their homes, automobiles, businesses, and communities, and for the security of knowing that if worse comes to worse, the losses will not be crippling. But more and more Americans are opening their mailboxes and checking their emails only to learn that this protection is being restricted, becoming significantly more costly, or major insurance companies leaving their policyholders altogether. Since January 2022, an astounding 31 states have witnessed double-digit rate increases. For lower-income homeowners and those on fixed income, rising rates can just about wipe them out of their homes. It increases the rental costs or force people to drop insurance altogether, which might otherwise be their sole source of funds to rebuild. And it is often the case that people in low and moderate income communities may both need insurance the most and have the least ability to pay the increasing cost of higher insurance premiums. Affordable housing providers and residents are among the hardest hit by insurance premium hikes, and those who cannot afford insurance sometimes go without. When Hurricane Harvey dumped approximately 4 feet of rain on Houston, Texas, an area in 2017, 8 out of 10 homeowners whose properties flooded did not have flood insurance. In 2022, insurance covered only 60% of $165 billion in total economic loss for climate-related disasters affecting millions of Americans. It is my hope that during this hearing we can get an answer to how the people in this room are going to work together to bring down the cost and increase the availability. Not the political legislation put forth for this hearing is to eliminate the federal government's insurance experts, but serious bipartisan solutions to the crisis. We know that there are several factors contributing to the increasing cost and decreasing availability of insurance for consumers in certain areas. This includes inflation-related costs, rising asset prices in hazardous areas, increased cost of risk transfer and reinsurance, litigation costs, and others. The most significant cost increase for property insurance has been attributed to the rising threat of climate change. As of October, the U.S. set a record of $24 billion disaster events in 2023, totaling $57.6 billion in damages. I think my time may be up, Mr. Chairman, but I have 6 minutes remaining. Prior to the 2025 insurance losses due to climate disaster never exceeded $50 billion. In response to climate-related risks, insurers can be expected to adapt their underwriting in various ways, some of which have adverse implications for the availability and affordability of insurance coverage in certain insurance markets. Concerning to me, there is not yet a systemic nationwide picture of what the climate crisis is doing to the availability and affordability of insurance. Let me be clear. Under McCarran-Ferguson, insurance is correctly regulated at the state level, but it is a national responsibility to understand, monitor, and supervise the response to the insurance crisis given the great national implications. You don't need to look much further than the NFIP, which was created in 1968 following widespread insurer withdrawals from offering coverage for flooding, to understand that insurers withdrawing from the markets or rising premiums leads to increased uninsured losses and shifts risk to consumers, lending taxpayers or the government to make up the rest. Congress needs to advance a long-term reauthorization of NFIP. Thank you, Mr. Chairman, for your indulgence.
Thank you. Thank the ranking member. Today, we welcome the testimony of Grace Arnold. Commissioner Arnold is the Commissioner of Minnesota Department of Commerce. She is here on behalf of the National Association of Insurance Commissioners. Mr. Robert Gordon. Mr. Gordon is the Senior Vice President of Policy for the American Property and Casualty Insurance Association. Mr. Frank Nutter. Mr. Nutter is the President of the Reinsurance Association of America. Mr. Joseph Petrelli. Mr. Petrelli is the President and co-founder of Dematec, Inc. in Dublin, Ohio. Mr. Baird Wabel. Mr. Wabel is a specialist in financial economics at the Congressional Research Service. And Ms. Sharon Lewis. Ms. Lewis is the Executive Director of the Connecticut Coalition for Economic and Environmental Justice. We thank each of you for taking time to be here. Without objection, your written statements will be made part of the record. Commissioner Arnold, you are now recognized for 5 minutes to give your oral remarks.
Chairman Davidson, Ranking Member Cleaver, and members of the subcommittee, thank you very much for the opportunity to testify today. My name is Grace Arnold, and I'm the Commissioner of the Minnesota Department of Commerce, which serves as the state's insurance regulator. And as such, I'm a member of the National Association of Insurance Commissioners, where I'm the co-vice chair of the Property and Casualty Insurance Committee, and I serve on the Climate and Resiliency Task Force. I appreciate the opportunity to testify today. The United States insurance market is the single largest and most competitive market in the world. State insurance regulators supervise more than 1/3 of global premium, and as of 2022, property and casualty insurance companies reported over $874 billion in direct written premium. The U.S. property and casualty insurance industry's cash and invested assets surpassed $2.4 trillion at year-end of 2022. State regulators share a mission to ensure a stable, competitive, and fair insurance marketplace where U.S. consumers are well-informed and well-protected. States work hard to strike an appropriate balance between insurer solvency and product availability and affordability. We oversee risk financing that allows individuals and businesses to thrive while preserving the ability of the sector to pay claims and otherwise meet obligations that result from financing risk. As we look ahead, state regulators are addressing several evolving dynamics. First, we're monitoring the interplay between the impact of inflation on pricing and claims, the rise of interest rates, and the fall of investment returns, and the impact of climate risk. These are a few of a host of other macroeconomic and real-world factors at play in our markets. This is not the first time state regulators have seen such cyclical growth and contraction in the property insurance markets, and we've taken action to address the particular challenges we see nationally and locally. State regulators have the capacity to respond swiftly and nimbly to market conditions in each of our markets. Through the NAIC, we are able to share ideas and coordinate effective responses, though our solutions do not have to look the same state to state. For example, the NAIC's Climate Risk and Resiliency Task Force has facilitated the implementation of climate-related risk disclosures by 85% of the insurance market. They've updated solvency formulas to reflect hurricane, earthquake, and wildfire risks. They've partnered with FEMA and the Institute for Business and Home Safety to create a more resilient and sustainable communities, and established a catastrophe modeling center of excellence to provide modeling resources. That group is in the process of a property data call to help better understand coverages and gaps. At the state level, recently Florida implemented changes to their claims litigation process, while California is in the process of allowing insurers to consider catastrophe modeling and reinsurance costs when requesting rate increases. In Minnesota, we borrowed the idea for a program to help homeowners improve the exterior of their homes from colleagues in Alabama and Louisiana and adapted it to the weather perils we see in Minnesota. All of these initiatives are responding to challenges in each state's property insurance market. We direct your attention to two ways that Congress can help to improve the resilience of our housing stock and drive down the cost of insurance. First, by reauthorizing the National Flood Insurance Program on a long-term basis, and second, by passing the bicameral, bipartisan Disaster Mitigation and Tax Parity Act of 2023, which would provide fair tax treatment to state residential mitigation grants. Another evolving dynamic that state regulators are addressing is the increased use of technology, big data, AI, and predictive analytics to reshape the insurance marketplace and the way insurers approach risk and engage with consumers. These technological developments have the potential to improve how an insurer does business and can benefit policyholders. Our written testimony provides context for these evolving dynamics and some of the long-standing and new initiatives state regulators are working on to address these challenges through the open and transparent NAIC process. I appreciate the subcommittee's leadership and look forward to addressing your questions.
Thank you, Mr. Gordon. You're now recognized for 5 minutes to give your oral remarks.
Chairman Davidson, Ranking Member Cleaver, and members of the subcommittee, I'm Robert Gordon, Senior Vice President for the American Property Casualty Insurance Association, the primary trade association for the property casualty insurance industry, and thank you for the opportunity to testify today. Insurers' core business is protecting people and helping them recover from catastrophic losses to their homes, cars, and businesses. And I'd like to be here today to tell you that the insurance industry is extremely strong, stable, and profitable, but I can't. Ratings agency AM Best last month downgraded the entire homeowners insurance industry from stable to negative, with a total number of downgrades of homeowners and car insurers more than doubling in just the first half of this year. APCIA reports regular financial operating results for the industry. Last year, insurance capital plummeted more than $73 billion. Our surplus contracted dramatically. Insurers' net underwriting losses last year were the worst in over a decade. And for the first half of this year, for every dollar collected in premiums, insurers paid $1.043 in claims and expenses. For this year overall, S&P predicts auto insurers are going to have an 8.7% net underwriting loss, and homeowners insurers a 12.1% loss, which will be the worst in over a decade. Our challenge is really simple supply and demand economics. Insured costs and exposures are rapidly escalating much faster than regulators are allowing in rate increases. An industry that is losing money is just not going to be able to attract new investment capital, and as a consequence, there's not enough supply of insurance capital to cover consumers' increased coverage needs. The average global natural catastrophe insured losses have nearly doubled over the last decade, and the United States this year has experienced a record number of recent disasters. Those numbers are increasing. The number one driver of property losses has been the accumulation of asset values in high climate risk regions. That's particularly from a rapid population growth in coastal areas and the wildland-urban interface, and that's a trend that accelerated with the pandemic. Economic inflation is the other top loss cost driver. Inflation has risen 22% over the last 5 years, but our insurance input costs have risen much faster, much higher, much worse than inflation. Used cars and trucks, which are the basis for auto insurance total loss settlements, increased nearly 40% over the last 5 years. The building replacement values increased 44%, more than double the cumulative inflation rate and far more than the increase in homeowners insurance. So a home in Florida or California that someone might have bought 5 years ago for $400,000 now costs nearly $600,000 to replace. Climate change is another cost driver, as is legal system abuse. They significantly reduce insurance affordability over time. Swiss Re estimates that U.S. liability claims costs rose 16% on average for the last 5 years, and that's fueled in part by some of the secretive third-party litigation financing. Insurance is fundamentally a risk pulling and spreading pass-through mechanism, and regulators in times of high inflation want to protect consumers from price increases, but if insurers are not allowed to pass costs through in a timely manner, markets are going to rapidly deteriorate, and that's what's going on right now in several states, causing deteriorating markets and crises. Our members, insurers, have invested billions of dollars developing insurance markets and relationships with the policyholders. They're loath to pull back from those markets, but you can't keep selling your product at a loss and remain solvent. Now, there are solutions. APCIA and our members have been supporting dozens of climate mitigation resiliency programs that can help reduce losses. It can help make insurance more affordable for consumers over time. The IBHS has developed extensive building code improvements, very exciting new wildfire safety standards, and we have worked extensively with the administration's Wildland Fire Mitigation and Management Commission that has recommended a number of great wildfire management and safety recommendations. And we're supporting improved vehicle and highway safety standards, particularly in some of the high-risk neighborhoods. And we hope policymakers can address inflation and climate change and legal system abuse. But ultimately, the markets are only going to stabilize when the gap between rates and losses is addressed and when property casualty insurers are allowed to earn a rate of return sufficient to attract the additional investment capital needed to cover escalating consumer exposures. I look forward to your questions.
Thank you. Mr. Nutter, you're now recognized for 5 minutes to give your oral remarks.
Chairman Davidson, Ranking Member Cleaver, members of the subcommittee, thank you for the opportunity to testify today and frankly for the many times over the years that this committee has honored me with that opportunity. At its core, insurance is the assessment of risk and a means to transfer individual property risk to a larger pool of insureds and capital providers. It has proven to be the most efficient means to provide financial recovery for property owners experiencing losses from natural catastrophes. Property insurance is at the intersection of extreme weather and decisions made by individuals and by the communities in which they live about the features of properties at risk and the resilience of communities that are, in the words of one analyst, creating disasters by design. This is reflected in the trends in insured property losses from natural catastrophes reflected in our statement. These trends are due primarily to increases in the number and value of properties at risk to extreme weather, external economic factors such as inflation, affecting construction costs, and increased risk vulnerability and hazard intensification. First Street Analytics assesses that of the 144 million properties in the United States, fully 1 in 4 are exposed to high risk due to wildfire, wind, and flood. People are increasingly living in desirable but dangerous places. Both the business model of insurance and the state regulatory system that oversees it are principally retrospective in nature, utilizing primarily past loss data. However, there is tension between both retrospective models in a world of dramatically increasing natural catastrophe risk and rising economic factors such as inflation. The past is truly not prologue in this context. Failing to incorporate future risk assessment into insurance rates and loss mitigation strategies dooms communities to solutions that will quickly become inadequate, subjects consumers to rate shocks as risk-based rates are implemented, and undermines one of the principal roles of insurance to communicate risk via rates. The rising cost of consumer insurance has been attributed in part to the cost of reinsurance. An insurer purchases reinsurance for a variety of reasons: to increase capital to support its portfolio of insurance in force, to diversify its risk profile across global and reinsurance markets, and to transfer the volatility of infrequent but severe loss events. Insurers are not required to purchase reinsurance, but do so because it is a cost-efficient way to manage catastrophe risk. Reinsurance rates are not the principal driver of the changing risk landscape. They're a reflection of it. Reinsurance costs do not translate directly to consumer rates. Reinsurance contracts cover a portfolio of properties above an aggregate loss experience and are not pass-through costs directly to individual properties. Reinsurance contracts terms vary by insurer, and rates charged to consumers by those insurers incorporate many factors. Reinsurance costs, even where significant, may be a small factor in consumer rates relative to other factors. Even if an insurer had no reinsurance, it would still need to set its rates to reflect a true risk-based rate. Insurers, reinsurers, and the utilization of reinsurance is regulated for financial oversight purposes pursuant to state law. That is understandable as each state has a unique profile related to its economy, its legal environment, its exposure to natural perils, and its philosophy of regulation. Well-meaning but restrictive insurance regulation is counterproductive to achieving solutions to property insurance market issues. Insurance regulation by each state should incorporate risk-based rates in a more efficient rate review process, include a factor for forward-looking risk assessment, and provide incentives for homeowners and small businesses to mitigate risk. We've identified a number of items in our written testimony about what Congress should do, but let me highlight 4. The first is to reform federal programs to incentivize people to live in resilient homes and communities. The second is increase funding for pre-disaster mitigation grant programs like FEMA's BRIC program and for funding for NOAA and NASA to improve weather and climate risk assessment. The third is to incentivize governments through federal disaster assistance to adopt statewide building codes and use forward-looking risk assessment in land use. And the fourth is to enact tax credits for pre-disaster mitigation, exempt state and local mitigation grants from federal income taxation, and encourage the private sector to invest in obligations of government at all levels for resilience projects, like those benefiting from the Community Disaster Resilience Zones Act. We look forward to working with the committee to enhance community resilience, recovery, and disaster preparedness. Thank you.
Thank you. Mr. Petrelli, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Davidson, Ranking Member Cleaver, and members of the subcommittee. I've been employed in the insurance industry since 1969 when I entered the College of Insurance, so I've seen over 50 years of availability and affordability crises. The one that the subcommittee is addressing is unique in several ways. While all lines of insurance are subject to fluctuations in price due to claims frequency and severity, the material damage lines, farm owners, homeowners, automobile physical damage, are directly impacted by the inflationary costs, materials, lumber, tiles, bumpers, grills, the inflationary costs on the salary, benefits, and training of the people who effect repairs, the shortage of those who effect repairs. The cost of reinsurance to spread the costs, yes, that's certainly included in the premium. But then we also, in catastrophe-prone areas, look at the efficacy and calibration of catastrophe models and the simulations upon which insurers base their purchase for reinsurance. But in addition to these traditional drivers of cost, this particular availability and affordability crisis we have found through research pioneered by Demotech, initiated in March of 2022, undertaken by Todd Kozakowski, a seasoned technologist with artificial intelligence, machine learning, and data analytics expertise, discovered that opportunists have been using the capabilities of the internet to initiate and generate contested claims against insurers. Demotech calls this tech-enabled claim instigation. It's the confluence of litigation financing, litigation marketing, litigation platforms, and search engine optimization by opportunists seeking to secure contested claims. This is a significant contributor to the availability and affordability crisis that this committee faces. A few examples will give you a sense of the scope of this issue. In the Southeast, a single law firm targeting a single regional carrier purchased over 100 keywords in an effort to outrank that carrier for its own claims department phone number. For successful clicks, the law firm paid over $300,000 per month. In Southern California, 19 law firms target insurers. Those 19 law firms spend nearly $1 million a month in online advertising. In 2022, when Hurricane Ian approached Florida, and in 2023, when Hurricane Idalia approached Florida, opportunists set up websites to report claims to them, not to insurers, 3 to 5 days before the storms were making landfall. They were still out in the Gulf. As the Maui wildfires burned, opportunists were setting up websites for consumers to report claims, not to the insurers, but to the opportunists. In closing, I paraphrase Alan Kerr, former Commissioner of Insurance, State of Arkansas from 2015 to 2020, when he was informed about our discovery of tech-enabled claim instigation. The threat that has been unearthed has never been identified at the state or national level until now. This is a new determinant in the availability and affordability that the subcommittee seeks to address. Thank you for your time. Thank you for your kind attention.
Thank you. Mr. Wabel, you are now recognized for 5 minutes to give your oral remarks.
Mr. Chairman, Ranking Member, members of the subcommittee. My name is Baird Wabel. I'm a specialist in financial economics at the Congressional Research Service. And before I go into my testimony, I just want to make sure, especially for people listening, that know that the CRS is a division of the Library of Congress. We are nonpartisan, and our job is basically to provide research and analysis to members of Congress. We do not take positions on legislation or policy measures before Congress. And so to address the hearing topic today, basically I see three somewhat interrelated factors that are driving the high prices of insurance, and many of these have already been addressed. You have two broad ones. In the macroeconomic environment, higher inflation, higher interest rates feed through fairly directly into insurance prices, and even more so when you have the inflation hitting areas like building costs and automobile replacement costs that are driving higher than the top line inflation. The other factor broad factor is increasing disaster losses. This has been going on for several decades. The level of catastrophe losses have been increasing across the country, and it hasn't been just the sort of headline high-level hurricane losses that people tend to think about. The losses are also coming in mid-level storms, in wildfires, in what in the insurance parlance is called secondary perils. The third and more idiosyncratic factor, I would say, is in some particular states, especially California and Florida. You've seen factors in the insurance regulatory environment that have driven market issues and market disruptions, supply disruptions, which will feed through into prices in those states. And of course, especially given the size of California and Florida, if prices go up in those states, you will actually see an effect in national statistics because of the size of the markets that they are. I think that when you look at these factors, of course, what people immediately ask is, so what can we do about it? And for Congress, I think if there's any good news in the situation, is that some of these factors are cyclical. Property casualty markets are prone to what are known as hard markets, where supply contracts, prices go up, and then the markets react. And so especially in terms of inflation, in terms of interest rates, we are not likely to see a situation where inflation basically goes from almost 0 to 6 or 7% again. And that shock is one of the things that really drives the problem in an insurance market. Insurance carriers in the past, in the 1970s, have adapted to inflation that is much higher than we have today. But when you have a shock where you go from essentially 0 to a higher amount, that drives disruption in the market. Equally, I think some of the states, both California and Florida, have at least started to address some of the problems in terms of changing some policies and changing some laws. And if that works through the markets, then the markets in those states may stabilize to some degree. Which leads to the third factor, which is driving higher catastrophe and disaster losses. And this, frankly, is a much harder thing to deal with. I think that at one level, what you can do is you need to do whatever one can to try to drive down those losses through mitigation, as was mentioned, through grant programs, through hardening properties, through trying to address the wildfire issues in terms of forest management, a really whole host of different things that the federal government might do. At the insurance side, in the past, the federal government has addressed sort of supply issues like this in the market in several different ways. In the NFIP, you see direct federal provision of insurance when the market failed. In the Terrorism Risk Insurance Act, you saw federal provisions of basically reinsurance to provide a backstop to the market as it started to fail. And also in the Liability Risk Retention Act in the 1980s, you saw what was essentially a deregulatory approach to try to increase private supply in the market. And so those are probably really the only 3 times that you've seen fairly deep federal involvement in these kinds of issues. It does not happen a lot. But it has happened, and I know that people are talking about using some models like that potentially in the future. And so with that, I will end my testimony, and I look forward to any questions.
Thank you. Ms. Lewis, you are now recognized for 5 minutes to give your oral remarks.
Thank you so much, Chairman Davidson, Ranking Member Cleaver.
Microphone.
Thank you. Can you hear me now? Thank you. Chairman Davidson, Ranking Member Cleaver, members of the subcommittee, thank you for this opportunity to testify today. I've spent more than 2 decades in the insurance and reinsurance industry. Now, I am the executive director of the Connecticut Coalition for Economic and Environmental Justice, where I work with low-income and communities of color who are facing health challenges due to disproportionate exposures to pollution where they live, work, recreate, and pray. Climate change is an undeniable reality, and consumers are paying more for less when it comes to insurance, while worrying about their coverage, worrying about whether or not their coverage will be reduced or canceled entirely. With every climate-related weather event, I see the same people destroyed but not being able to recover from the devastating financial effects. I see people who have managed to accumulate a modicum of wealth but lose it in an instant as a result of a hurricane, flood, wildfire, heavy rain, etc., because they didn't have adequate coverage or had no coverage at all, yet they pay more for quote-unquote insurance than anyone else. For a community to become uninhabitable, it only needs to be uninsurable. This has been a historic problem for low-income communities and communities of color. Think about urban renewal. Due to a history of government-sanctioned racial policies, such as redlining and restrictive covenants, which led to the abandonment and underinvestment in these communities, they now face disproportionate threats from climate disasters, which can leave them traumatized by the devastating shortcomings of the insurance claims process. Insurance, by design, is supposed to protect one's assets, but in communities of color, it has too often eroded their assets through discriminatory underwriting and claims policies. Climate change is also revealing an underinsurance crisis as insurers transfer the risk to their policyholders through ever-increasing deductibles, low property value assessments, or policies that only offer actual cash value rather than replacement costs. After disasters, insufficient coverage can often force a housing crisis as well, as people tend to start from square one, creating a vicious cycle of displacement. No insurance means no mortgage, so it could also create a mortgage crisis. This is also true for renters who pay higher rental insurance premiums, if they can get it at all, or pay higher rental costs to cover the landlord's premiums. As climate change accelerates an insurance crisis, we need to pay close attention to the concerning underwriting practices like the use of credit scores to determine premiums, which can force people of color to pay far more for insurance, regardless of whether they have an undesirable risk or have even filed claims. There's also a clear double standard in who pays the costs of climate change. While insurers have been dropping homeowners' policies, they continue to invest in and provide insurance for new fossil fuel projects, which will only increase the threats to people's homes and lives through climate change. The CEOs of these companies should have to explain to all of us about this contradiction publicly. Ultimately, the best policy to protect consumers is to reduce the risk. Congress should work to reduce carbon emissions and invest in resiliency projects to prevent communities that contribute the least to climate change from paying the most. Finally, Congress should work with impacted communities and consumer advocates to consider a backstop that could serve as a reinsurance relief valve. In 2002, you provided relief for Wall Street for terrorism insurance after 9/11. This time, we need a safety net for those on Main Street who've been terrorized by higher premiums, terrorized by higher deductibles, terrorized by coverage restrictions and market withdrawals. Thank you so much for this opportunity to speak today.
Thank you. I thank all of our witnesses for your oral remarks. Look forward to the questions. We'll now turn to member questions, and I recognize myself for 5 minutes of questioning. Mr. Petrelli, the company you founded with your wife Sharon, Demotech Incorporated, independently reviews and rates 450 insurers operating in every state. In addition to the traditional drivers of insurance costs, you've recently done a lot of work on a new and troubling expense category that you just highlighted in your remarks, tech-enabled claim investigation, which is exploding costs, particularly in places where we see more frequent natural disasters. And could you tell us how they work together and how this phenomenon is contributing to higher premiums?
There we go. Chairman Davis, Ranking Member Cleaver. Yes, thank you. What we've seen is the turmoil associated with a natural disaster, whether it's flood, hail, tornado, earthquake, hurricane, whatever it may be. That turmoil serves as sort of ground cover and camouflage for the efforts, and it creates an opportunity for opportunists to utilize technology to secure contested claims when there might not have been a contested claim. We had situations recently in Louisiana, the McClenny-Mosley Associates, there was almost 1,000 people who were represented by counsel who did not know they were represented by counsel. And so it winds up with what's called in the insurance industry, first notice of loss becomes a lawsuit as opposed to an inquiry from your insured as to what the claim might be. And what we're seeing is we've always had litigation in the insurance business. We now have another layer of litigation that's being imposed through tech-enabled claims instigation. I'd be glad if there's a follow-up question, I'd be glad to take it.
No, I thank you for highlighting it, and I look forward to researching it. I hope my colleagues will pay attention to it too, and frankly, our state-based regulators will pay attention to that because it's just another predatory practice. People are adapting to the times, and instead of just distributing risks, it's actually concentrating it and kind of works at odds with the point of insurance. So shifting gears, earlier this year, the NAIC put forward a proposal to expand the reach of its own Securities Valuation Office. The proposal would give the SVO the power to overrule a rating agency's determination when the SVO decides that it disagrees with the agency's ratings. This SVO expansion would essentially make the NAIC an unregulated, de facto, nationally recognized statistical rating organization and create a conflict of interest between its role as a trade association representing state-based insurance regulators and an asset evaluator setting capital charge rules for insurance companies. That's why earlier this year, I and 7 of my colleagues on the committee sent the NAIC a letter expressing serious concerns with their proposal. We are concerned that this SVO overreach would lead to less transparency, more ambiguity for insurance companies, and actual damage to market efficiencies. This would drive additional costs for our consumers. Mr. Gordon, do you see how this could be a conflict of interest given the NAIC's dual role as a trade association for all state insurance regulators and an evaluator of investment decisions of its member insurance companies?
Yes, Mr. Chairman, we would agree with that. The Securities Valuation Office has continually tried to assert more control over securities rating, including giving itself discretion for a fee to evaluate some of these products, but there's no provision for appropriate supervision by state regulators. As you note, very limited transparency, no right to appeal to an independent third party, and no opportunity for insurers and rating agencies to present their data. So we have objected to the proposal and think it needs a lot more transparency and due process before it's further considered.
Yeah, thank you for your testimony. I just want to quickly turn to the Federal Insurance Office. Back in March, I sent a letter to FIO regarding its politically motivated effort to collect climate change data it's expansive beyond its actual scope. Instead of working directly with state insurance regulators, it's going straight to the companies and basically trying to extract data. So one of our colleagues, Mr. Fitzgerald, has a bill, H.R. 5535, the Insurance Data Protection Act, which would strip FIO of subpoena power that it is actually abusing. Does anyone on this panel think getting rid of that power would compromise the original intended purpose of FIO?
We would strongly support that, Mr. Chairman. It's an incredibly unusual, unique subpoena power for a non-regulatory agency.
Thank you. Anyone else? Look, I think, as my time rapidly winds down, the ability to distribute risk is an underappreciated, essential component of market function, and it frankly preserves capital if it's done properly. So I think it's great that you guys could be here. My time's expired, and I now recognize the gentleman from New York, or the gentlewoman from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Commissioner Arnold, I am concerned about the rapidly increasing insurance costs for multifamily housing properties serving low-income New Yorkers. Some affordable housing properties cannot get an insurance quote at all, with fewer carriers willing to bid on properties that serve rent-subsidized tenants and some outright refusing. What can be done to ensure affordable housing properties have access to property insurance at affordable and reasonable rates?
Thank you for the question, Chair Davidson and Representative Velasquez. So, the market looks a little different in each state. For the most part, our insurance markets are competitive. There are a lot of carriers. We've seen that when folks shop around, that is a way to get better coverage or a reduced cost. I talked to a gentleman recently who saved $800 a year, which I was quite surprised. So, it's also something that we're looking at. We are thinking about the ways that we can, ensure that there is access to coverage, and we do that through our regulatory process.
And this question is for the panel. In September, not only did Republican brinkmanship here in the House bring us to the verge of a government shutdown, but it also brought us precariously close to an expiration of the National Flood Insurance Program. This was on the same day we were experiencing a massive rainstorm and significant flooding in New York City. By a show of hands, how many of you think it will be a terrible idea to allow the NFIP to expire? Thank you. Similarly, by a show of hands, how many of you think we should stop lurching from deadline to deadline with the NFIP and instead pass a long-term reform and reauthorization bill? Thank you. Mr. Nutter and Mr. Gordon, both of your organizations have closely tracked the impacts of Risk Rating 2.0. In each of your views, has Risk Rating 2.0 worked to lower rates nationwide? What about in LMI communities and communities of color in high-risk areas? Mr. Nutter.
Yes, thank you for the question. We do believe that Risk Rating 2.0 will bring more equity into the rating for flood insurance policies. It needs to be understood that the former program, let's call it Risk Rating 1.0, and Risk Rating 2.0 were both by Congress required to meet a certain rate adequacy level. So they're both on that track. What Risk Rating 2.0 does is that it eliminates this cross-subsidy of people at low risk to flood, of people that are high risk to flood, and it does bring equity into that by looking at property-specific. Our analysis would suggest that a significant portion of the properties that in fact are covered under the policy are going to receive lower rates, and many of them are going to receive basically the kind of rates that would have been happening under Risk Rating 1.0 anyway.
Do you foresee any positive impact on communities, underserved communities and community of color?
Absolutely. I think this is what Risk Rating 2.0 is going to do, is to bring more equitable rates to communities of color and communities that are socially and economically vulnerable.
Mr. Gordon?
Yeah, I generally agree with my colleague, Mr. Nutter. I would note that when the federal government creates subsidies for the environment, it can mask not only what the true cost is, but it can also, in essence, mask the environmental signals that we're not recognizing those environmental risks. And that's what's going on. If Congress wants to address the very important concerns that you've raised, perhaps some sort of a very transparent means testing program to help those people, as well as the right kind of mitigation investments in those communities that can help them withstand the flood, that's probably a much better alternative than trying to mask those very important environmental risk signals.
Thank you. Mr. Chairman, I yield back.
Gentlelady yields. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Arnold, given the commitment to the state primacy for insurance regulation in the McCarran-Ferguson Act and the success of NIAC in meeting the needs of interstate commerce through coordination among the states, what, if any, is the role of the federal government on insurance?
Thanks for the question. So the state regulators, as you've noted, are the insurance regulators within the country. We have the authorities.
Can you speak up a little bit?
Oh, sorry. There you go. Is that better?
Yeah.
All right. We have the authorities to oversee the financial solvency, to approve policies that are sold, and to do data collection. So, as you noted, we are the regulators of the industry. Certainly, we're in conversations with the Federal Insurance Office about the activities that they're working on, and I think we have as everyone here does, have a shared interest of consumer protection and solvency and health of the industry. But at the end of the day, that we are the state regulators. We are the regulators.
Mr. Gordon, same question.
Yeah, so when FIO and the state regulators are working together, particularly internationally, it can help support our international voice. But when we have FIO starting to set arbitrary thresholds for insurance affordability, domestic, it becomes more problematic. When they second-guess the regulators, that becomes problematic. We have particularly strong concerns about FIO's unnecessary data calls that we discussed earlier, incredibly unusual for a non-regulator to have that kind of expansive subpoena authority. We really hope that FIO can work with the state insurance commissioners, who are the primary regulators, and both of them coordinate with each other, conduct any data calls through existing state reporting systems and the statistical aggregators, and hopefully Congress can help encourage that communication. But we need the states as our primary regulators without being second-guessed.
Mr. Gordon, one of the reasons given for the spiraling insurance costs in Florida has been the structure of litigation. For example, the assignment of benefits. I think that's what Mr. Petroselli was talking about, the leeches and parasites, bottom feeders or whatever that inject themselves into this process. What reforms in litigation processes would you recommend to help tame the increases in their premiums and make insurance more affordable?
Great question, Congressman. And Florida's leadership over the last year has adopted just very historic, significant legal system abuse reforms, trying to rein in one-way attorney fees, phantom damages, assignment of benefits. One giant stone, though, left unturned is third-party litigation financing. We've got billions of dollars pouring into funding U.S. lawsuits from unidentified parties, oftentimes even unidentified foreign sovereign wealth funds, and some of the civil defendants in courts don't even know when it's happening. A related challenge is third-party medical financing, where you have unknown third parties who are essentially in cahoots with the medical providers to maximize the medical services and costs. Insurance ends up being tried to force to pick up the bill. Fees charged are often far in excess of normal rates. And we have no transparency in this area. We have very little regulation to protect the consumers. We really need some more transparency in this third-party funding to stop the fraudulent, usurious activities. So any legislation, oversight, investigation, transparency would be very helpful.
Thank you. Mr. Weeble, the GAO has written many times over the years that the federal government should not purchase insurance but should self-insure. Some of this is apparently based on the fact that the federal government has little reason for the same risk adversity as private entities. Can you please explain and expand on the basis for GAO's persistent position on this matter?
I would assume essentially when you look at it from an economic perspective, I mean, insurance is typically something you buy for a risk that you cannot cover. I mean, if you're purchasing insurance, I would typically recommend someone get as high a deductible as possible to minimize the costs to themselves for what they're buying. If you look at the federal government and the federal government's resources to cover what insurance might cover, when you can, at least as we have been able to, borrow at the kind of rates that Treasury has borrowed at and the like, it doesn't, from a purely financial perspective in most things, make much sense to purchase insurance.
Okay, my time has expired, Mr. Chairman. Thank you. I yield back.
I thank the gentleman. The chair now recognizes the gentlewoman from California, Mrs. Waters, who's the ranking member of the full committee, for 5 minutes.
Thank you very much, Mr. Chairman, for this hearing. I've been reviewing our witnesses here today, and of course, thinking a lot about my state of California, where we have had insurance companies exit the market or changed in some way because of the fires and the catastrophes we've had. So with the fact that the states basically are the regulators of insurance, why are we here today? Who can I ask this question to? Let's see. We have a lot of experts out here. What are you recommending as responses to the fact that insurance companies believe that the premiums that people pay does not cover the cost of the catastrophe when it takes place? And while you are answering this question, I'd like to know what role does climate change play in all of this? And if you have recommendations or you have some special information, exactly what would that be? Who would like to start off with this? Ms. Lewis, can you help us out?
I'll try to help you out a little bit. You don't need to be a climate scientist or a congressperson to see how climate change is impacting people, including in my community in Hartford, Connecticut, and around the United States. Of course, climate change is a main factor in influencing recent insurance price increases. Of course, climate change is a main factor in influencing the exiting of insurance companies from entire states. Of course, climate change plays a major factor in the increase in premiums. I have written, I've provided written testimony which will further explain why I feel so strongly about this. And I would like for you to refer to that if you don't mind.
Thank you very much. We have some other witnesses here that I'd like to hear from based on recommendations, based on what we know is happening in the industry. Let's see. Mr. Robert Gordon, Senior Vice President, Policy Research and International American Property Casualty Insurance Association. So you must know a lot. What do you know about what the federal government should be doing or could be doing at this time?
Well, I may know a lot, but my kids remind me every day nowhere near as much as they do. But one thing we do know is this is according to the NAIC's most recent report on profitability. Insurers in California had a 6% net underwriting loss over the last decade in California. Homeowners insurance claims were more than 13% higher than the premiums, and the wildfires in 2017 and 18 wiped out more than 30 years of underwriting profit. So there's been enormous losses. There's been bad rate delays for insurers to try and catch rates up to these losses, where often it takes a year to get filings approved. I will say, though, that to their credit, California governor and the insurance commissioner have both committed to making significant reforms in those markets, including allowing forward-looking modeling to take climate change into account, to improve the rate filing process, to address the intervenor process, to allow reinsurance costs to be factored in. So there's a recognition that the California market is rapidly deteriorating. It needs a fix. And I think the best summed up by the California Insurance Commissioner, who said insurance companies will not write insurance, especially in high-risk areas, unless they're able to ensure they have the capital and reserves to meet all the claims but submitted by consumers, cover their expenses, and earn a fair rate of return. So we are committed to working.
If I may interrupt you
with
for a moment, I want to know if anywhere in that testimony you're recommending higher premiums to cover the cost of these losses.
Yes, ultimately, insurers will need to make enough premiums to be able to pay losses long-term.
That's exactly what I do not want to hear. Thank you. I yield back.
Thank the gentlewoman. The gentleman from Missouri, Mr. Luke Meyer, who's also the chairman of the Subcommittee on National Security and Illicit Finance, is now recognized for 5 minutes.
Thank you, Mr. Chairman. It's a breathtaking comment a minute ago. How you can pay your expenses without any income. I don't know how that works. Insurance companies are like any other business, as far as I understand, as far as I know your business model. You take in premiums to be able to pay the losses that you incur, and if you take in less premium, you have less ability to pay that. Would that not be the case, Mr. Gordon?
That's absolutely right.
Now you have losses that you're talking about here. Autos 8%, homeowners 12%. I guess the question I have is with regards to frequency or numbers of occurrences. Is the frequency the same roughly as it has been, and inflation is additional cost of the loss here, or is it increasing frequency, increasing numbers of losses, as well as an inflation and the cost to be able to make people whole?
It's inflation, it's people moving into the higher risk areas. There are things, for example, much more frequent severe convective storms, thunderstorms, although that's generally understood by the industry not to be impacted by climate change. There are things like increasing droughts and wildfires that are more impacted, but inflation and the demographic shifts are the top cost drivers at the moment.
So people like to live in certain places, but it also means that they're living in places where you actually have more losses, or they're more susceptible to sustaining a loss. Is that be correct?
That's correct.
Very good. Mr. Nutter, thank you for your service for many years of being able to appear in front of this committee. I'm sure you've got some stories to tell, but we'll leave that for another day. But I wish you well on your retirement. Quick question for you. I know a few years ago I chaired this committee and we were working on flood insurance. And I've been an advocate for a long, long time of reinsurance to be able to minimize the taxpayers' exposure on flood insurance. They now have some, but not, in my view, not near enough. Would you like to explain to us the benefits of reinsurance for the flood insurance program so you can minimize the taxpayers' risk?
Well, thank you, Representative Luke DeMeyer. The reinsurance that the flood insurance program purchases has in fact been a valuable way to insulate the taxpayer, largely through the borrowing from Treasury, by calling upon private sector resources, reinsurance, if you will, to pay claims. The first year of the program, which I think was 2017, the federal government collected from the industry over $1 billion in losses, just like an insurance company would for losses that it has. So I do think it's an effective program, and frankly, it's a way for the insurance sector to understand better the flood risk with a view toward developing more of a private flood insurance market.
Would you think it'd be a good idea for us as legislators to look at doing this in other areas of government where we could pass off some of the risk to the private sector versus having taxpayers take all this risk?
There are some existing programs that do just exactly that. Fannie Mae and Freddie Mac purchase risk transfer products from the private reinsurance sector. The EXIM Bank does the same thing. The one area that is poised for that opportunity is the banking sector, and that is that under the Basel III, it's called Endgame, in Europe, that the banks are permitted, in fact encouraged, to buy reinsurance as part of their risk transfer. That is not yet true in the United States, but given that the Federal Reserve, the OCC, and the FDIC are considering new bank capital standards, we have advanced a proposal that they should do as some of these other federal agencies have done, and that permit banks to get diversification for their capital base.
I see Mr. Wable would like to join in.
Yeah, I just add one other thing that I think in the context of the NFIP, the reinsurance, by purchasing it now, basically has the effect of drawing future losses to the present. So the way the NFIP was designed before this, essentially, you know, it wouldn't, if you had the same policy holders, it would be fine. But when you have a policyholder that has a house and then they sell it and then to the next person, the first policyholder that held it for 10 years and didn't have a claim essentially was getting what amounted to a subsidized rate because they weren't paying the same look forward that you would in a normal insurance context. And buying the reinsurance now essentially brings some of those future losses to the current.
Okay. Mr. Petrelli, very quickly, my time's running out here. You talked about the tech-enabled folks that are actually trying to rip off the insurance companies. I hadn't heard that there was an orchestrated effort out there by, I know seems to be like a cottage industry of ambulance chasers out there, but you've taken it to a whole nother level with the way you were describing this. Would you like to elaborate on just a little bit? I mean, we have groups of attorneys out there that use algorithms to go out and put together claims against companies.
Yes, sir, it's Moneyball. It's litigation platforms, litigation funding, the money that comes into the litigation financing area. Bloomberg in 2022
My time is up. Can you really very quickly, what's the cost, additional cost on an average insurance policy? Does it go up 2%, 10% as a result of this activity?
I would guess based on the frequency, it might be as much as 30 or 40%.
Oh my gosh. Thank you very much.
The gentleman's time's
Yield back.
expired. The gentleman from Missouri, Mr. Cleaver, the ranking member of this committee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm not sure. I think what you Mr. Gordon, mentioned the means testing, and I'm going to want to connect the means testing you suggested with some other issues. Primarily, we've had congressional hearings on the issue of non-profit organizations and insurance. And there are a number of nonprofits who are struggling with this, most especially those who work with animals, children, senior citizens, the disabled, churches, synagogues, mosques, and temples. And they are now really struggling to get the insurance they need to survive. And when you think about the fact that there are 60, well, more than 60 nonprofits in my congressional district, including the United Way of Greater Kansas City, Veterans Community Projects, Goodwill of Western Missouri and Eastern Kansas, and the members receive liability insurance from the Nonprofit Insurance Alliance. But they are saying that they are still challenged. Ms. Arnold, Mr. Gordon, I'm interested in what I can tell them about their struggles and how we want and what we can do to repair it.
Well, they're actually a member of our, certainly Congress has looked at these issues in the past when there were hard markets and liability to find solutions. Now we're seeing some hard markets on the property side, although it doesn't appear to be a capacity issue at this point. It's really more of a market rate freedom issue. So if we can get the right rates, we can provide the additional coverages. I think that there may be some groups where those coverages become less affordable, and that's where policymakers need to decide whether it's a transparent means testing or whether it's providing very targeted mitigation, resiliency. Certainly, it's better to try and reduce the loss cost that those groups would be exposed to.
Ms. Arnold.
Thank you for the question. I think, making sure that there's insurance, particularly for the entities that are providing really critical services to our constituents, is something that all insurance commissioners take very seriously. One thing, there have been a number of solutions that have been proposed. Generally speaking, we are, the regulators and our, we generally oppose anytime there is a federal solution to a place where there's a state solution in place. This is one of those cases. I will say that we have a data call that is going out to try to understand this challenge a little bit better. We certainly want to make sure that there is access for some of these critical services. We'll be looking at the data that comes in, and we'll perhaps be following up, but we'll get a better understanding of the particular challenges and where we need to be thinking as state regulators to see whether there are any policies that we need to be looking at or any changes to the way that we do business.
Well, to all of you, though, the more difficult their problems, the problems they're trying to address, the greater their insurance needs. And so people who are doing, the Lord's work, I'm not just talking about religious institutions, but dealing with tough situations with human beings. And so, their reward is you got to pay, the insurance is going to skyrocket on you. And I don't think this is a partisan issue. I think it's a serious issue that we really need some direction on. Anyone else would like to address this?
If I may, on the issue of the tech-enabled claim instigation, to give you a sense of the growth of that problem, in a National Law Journal article, November of 2021, there were 800 professionals using a particular litigation platform. 15 months later, there was a press release on that same litigation platform. It had 45,000 professionals using it in 15 months, from 800 to 45,000. I would respectfully submit that your constituencies are being targeted, sir.
Thank you very much. It's not what I was anxious to hear either, but thank you very much. I appreciate the additional time, Mr. Chairman.
Thank the gentleman. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you, Mr. Chair. For about 150 years, state insurance regulators and laws have regulated insurance companies. I know my own state of Wisconsin, of which I was a member of the Wisconsin Senate for 25 years. We always had a great relationship with our insurance commissioner. The market and the corporations that operate and function, whether it's P&C or health or life, whatever it might be, they do a fantastic job, right? But what we have here is, once again, something that most state legislators really bristle at, and that is a federal overreach. FIO has grown increasingly aggressive, as been discussed by the chairman, and so in consequence of that, we're offering legislation. Just the collecting of data, and most recently issuing a revised proposed data collection for climate-related financial risk, it just puts us in a position of, once again, trying to push back. So not only has the office been unclear on what they're going to do with this information and the data that they've collected, but any effort by Treasury or FIO to sidestep state insurance regulators, it just blatantly undermines the congressional intent in this area. So, as the chairman said, that's why we've introduced Insurance Data Protection Act to repeal FIO's subpoena power. Mr. Gordon, I know you've already commented on this, but maybe you could take it a step further in the way you guys view the subpoena power and how it's being abused right now.
Yeah, we're very appreciative of your leadership on this issue, Congressman, and we have not found one single other example of a non-regulator having such expansive subpoena authority. And there's no reason for them to get into this because majority of the states have already been conducting climate data calls, as Ms. Arnold noted in her testimony, for 85% of the marketplace. This is analyzing weather is already the primary competency of the insurance industry, doing it for hundreds of years, investing money in analyzing and managing weather risks. So this is something, it's not related to insurance. It's second guessing the regulators. We're working with the regulators very extensively on this. They're spending a lot of time. There's enormous amount of climate-related insurance data already available in the public, and we're working with our state regulators to make sure there are no gaps in that.
And I mean, I would further comment that I think some of the data calls are so broad that you start to worry about whether or not they're adequately protecting this information once it's been gathered. What would you say is, what kind of assurance do you think that FIO could give to anybody saying, don't worry about this data, it's all been guarded and safely kept?
Well, we're always nervous. The more parties have information, the more potential problems there are. We have encouraged FIO in past efforts to gather information to work with the NAIC, to have the data done through existing portals, to be aggregated to protect against the kind of dangers that you're talking about. So there are ways to do it, again, most importantly involving cooperation with the state regulators.
Thank you. Chairman, I'd just say this is once again just a classic federal overreach for data that's absolutely not needed. I yield back.
I thank the gentleman and appreciate work on this bill in particular. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all the witnesses that are with us here today. This is again, a very important topic, especially to someone like me who is from Houston. I know that the ranking member has already mentioned some of the disasters and flooding that we have suffered. In fact, in 2019, Hurricane Harvey left much of my district underwater and created major damages throughout the Houston area. Now, years later, many households in Houston have dropped their flood insurance for the reasons that the ranking member mentioned, largely due to lack of affordability. Harris County, which is home to Houston, is projected to see a 75% increase in the average flood insurance premium. Ms. Lewis, I want to start with you. Given the increasing intensity of weather events resulting from climate change, can you speak to the importance of not only reauthorizing the National Flood Insurance Program, which you all raised your hand and said you were in favor, but what could we do more than just reauthorizing it to make it more affordable? You mentioned the safety net that we have to worry about. Someone mentioned the means test. What is it that we need to do to make sure that when we reauthorize that it's also actually affordable so that we can make sure it's accessible to everyone that needs it?
Thank you so much for that question. As you can probably glean from my testimony, I'm very concerned about discriminatory practices by the insurance companies. And to me, making something affordable or more affordable is making something fair, making sure that the underwriting practices do not penalize people because of what their color is or where they live. It's very important to understand that in the underwriting process, since the very beginning of insurance, it's always been discriminatory. It's always been these people who live in this certain part of town are going to pay more. So it's really critical that everything be fair across the board and that you and I should pay the same if we live in the same area for flood insurance.
Is there anything that we can do in terms of ensuring that people who sell the insurance can do it on payment plans or any kind of working with the individual based on their income and then based on the value of their home, rather than just this is what it costs and this is what you got to pay?
Well, I agree, because one of my concerns is that there's no transparency when it comes to the rating structure of insurance. I don't know if anybody here can tell me how their insurance premium was promulgated. Can you tell me how they came up with $600 per month or $6,000 per year? I can't think of any other industry where they give you a bill, but you don't know how that bill was determined.
We don't even know there's any hidden fees there.
Absolutely, because underwriting has always been subjective, and underwriters will determine whether or not you get a debit or a credit based upon what they perceive as a risk And it's something that we should all consider nationally to make insurance fair. Get rid of this subjectiveness. I used to sit next to underwriters, and we'd have the same risk, but different prices. Why is that so?
Thank you. Ms. Arnold, well, I recognize that the flood insurance program we're talking about is a federal program, but I have concerns similar to that of the Ms. Waters from California. Texas has an insurance board. It regulates a lot of what the insurance companies do in our state, much like I'm sure in your state. What is the role of the state in making sure that insurance is affordable?
Thanks for the question. So our primary roles as state regulators are, our first consumer protection is to make sure that companies can pay claims when you make a claim, and that involves making sure that there's sufficient capital and that rates are adequate and not excessive. We also look at policies to make sure that they comply with state law. All of those things.
No, but my question was specifically to make it affordable. I know all of y'all have a lot of regulations.
Right. Yeah, and so we're also looking to make sure that the markets are competitive, which helps with affordability because carriers are competing with your for your business. That's sort of the base of what we do for affordability. The other things that we have been working on, particularly to some of the concerns that you've raised, are pre-disaster mitigation. So that's making sure that your home, or in some cases your community, is more resilient to the particular perils that are in that community.
The gentlelady's time has expired.
Mr. Chairman, I also would like at the appropriate time, I know that on my desk is a report of some sort, but there's no explanation or where it came from. Did everybody get this? Yeah. I just
we'll get an answer for you on that.
It's basically a point of inquiry, if someone would explain what this is. And
we'll get you an answer on that. The gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to start by highlighting some of the work done by insurance regulators in the great state of Nebraska. Nebraska is one of the nation's top states for insurance, with domiciles like Berkshire Hathaway, Pacific Life, and Mutual of Omaha. They're a leader in the space, and a big part of that reputation is the experience of the Nebraska Department of Insurance. I know firsthand from my time in the legislature that we work hard to make policy that keeps premiums affordable in Nebraska. Some other states have seen higher premiums, at least in part because of the restrictions they've put on pricing. Mr. Gordon, can you speak to the challenges that can be associated with states that use pre-approval filing systems for insurance? How does that affect things for property casualty insurers in that state?
Sometimes it varies on the state, so you can have good states or bad states in either case. But when you have the pre-approvals, it can often create great delays. So for example, in California, the state went for over 30 months without approving a single private passenger auto rate increase. Over 30 months in a time of record inflation. You can imagine the kind of devastating losses that causes in the marketplace. You also have, particularly in California, a very antiquated, broken 35-year-old system that the governor and commissioner are now trying to address. Every state allows forward-looking catastrophe modeling and rate filings except California. Every state allows reinsurance costs to be included in rate filings except California. Every state allows consumers the choice to use telematics based on actual driving behavior except California. When you have these factors that essentially constrain innovation, create long delays, you're going to create a lot more market dysfunction. That's actually why the Florida market originally deteriorated so badly. It used to be filled with national carriers. After Hurricane Andrew, there was horrible rate suppression, and the number of national carriers in the state plummeted dramatically. We've seen some of that in Louisiana and very much now in California.
Can you speak, Mr. Gordon, to the challenges presented for insurers that have their hands tied regarding what metrics they can use for underwriting and setting rates? Specifically, I'd like you to touch on restrictions related to credit ratings and location. We're starting to see state legislatures wade into this credit rating business, and I'd like you just to comment on that.
Yeah, we actually have a couple of studies that we published, one that shows there used to be an enormous number of drivers in the state residual markets. They weren't able to get regular insurance, but with the advent of credit scores, suddenly there was an easy, very affordable tool to get that insurance, and those residual market populations plummeted dramatically. People got insurance. We also have studies published recently that show a direct connection between credit scores and actual hard braking, hard acceleration driving behavior. And we've done recent studies, especially some of our partners at LexisNexis and elsewhere, looking at credit scores showing they are in fact not discriminatory, they're not a proxy for race, they are highly predictive.
I'm going to switch gears just a moment here. In October, just really a few days ago, we had InsurTech on the Silicon Prairie, a summit in my home state. The summit had a great turnout with over 400 attendees from 44 states, 3 foreign countries. Mr. Nutter, could you speak, and maybe others on the panel if so inclined, to the importance of insurance technology and innovation in terms of putting downward pressure on premiums going forward?
Well, there's no question that the incorporation, assimilation by the insurance industry into more technology will advance the efficiency, if you will, of both rate setting, both for regulators, insurance regulators, as well as the industry. It's the broad trend, particularly with artificial intelligence, that will make the underwriting more precise and then the rating more equitable.
Would any other panelists like to comment on that? Seeing none, I guess what I have one final question here. In August of this year, the NAIC released a draft bulletin on artificial intelligence and predictive models. Mr. Arnold, could you just comment on your initial reaction to that bulletin?
Thanks for the question. So the NAIC has done a number of things to, look at how AI is getting used within the insurance industry. We had an AI principles document that came out a couple of years ago that was, sort of laid out the frameworks. We've also created, a letter committee. So if you are around the NAIC, we name things by letters. It's our Big Data, Artificial Intelligence, and Technology Committee. That committee's entire umbrella is looking at the various issues that arise when there are new kinds of technologies.
Thank
so
you.
We're looking at it.
Unfortunately, I'm out of
I
time,
appreciate
so
it.
I appreciate you, and I yield back.
The gentleman's time has expired. In answer to the gentlewoman from Texas, Ms. Garcia's inquiry, the slide that was referenced as part of the written testimony submitted by Mr. Nutter, and it is referenced in the top left corner with the risk assurance, the appropriate agency, the risk assurance group that he's part of. So that's the slide. It is customized per each member's district. The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Chairman Davidson and Ranking Member Cleaver, and thank you to our witnesses for joining us today. Y'all, we are once again rapidly approaching a potential government shutdown, and it seems like every month in this Republican-controlled House, we're faced with yet another preventable crisis after another, putting our national security and our economy at risk. Keeping with the theme of my Republican colleagues avoiding problems until they're actively harming our constituents, let's talk about climate change. Let's talk about how it is contributing to the rising cost of insurance today. Republicans can't even consistently agree that humans are impacting our climate, let alone say the words climate change. But y'all, I live in the real world, and I believe in science, and I know that climate change is real and has a real impact on our constituents and on our economy. Ms. Lewis, this hearing is entitled Factors Influencing the High Cost of Insurance for Consumers, and as you stated, of course climate change is a major factor influencing recent insurance price increases that are burdening consumers. But unfortunately, the Republican memo for this hearing doesn't even use the phrase climate change anywhere. Ms. Lewis, do you think it's constructive to have a conversation about increasing insurance costs without even acknowledging climate change?
Absolutely not. You must acknowledge the reality of climate change.
These are policy decisions, y'all. And while my Republican colleagues can act as if climate change is not real, people in marginalized communities, myself included, we don't have that luxury. This past July, I shared with y'all that State Farm decided not to renew my homeowner's insurance policy because I filed a claim after a hailstorm that damaged the roofs throughout my entire neighborhood in Southwest Atlanta. That was just in March of this year. And even though I can't control the weather and you can't either, I'm now considered high risk and have a much more difficult time finding insurance that I can afford. And this is impacting all of my neighbors. Y'all, low-income Americans are more likely to suffer from the consequences of flooding, tropical storms, and other extreme weather due to inadequate infrastructure in their neighborhoods and lack of proper insurance. This summer, when this committee decided to launch a full-scale attack against ESG, I submitted questions for the record to several of our witnesses. Jerry Theodoro from the Art Institute was kind enough to submit formal responses and let me know that a long-term reauthorization of the National Flood Insurance Program and some key reforms would contribute stability and affordability to the flood insurance market. The multiple short-term extensions of the program have been a source of destabilizing uncertainty to the market. So now, more than ever, with climate change causing more frequent and more damaging flooding, Congress and this committee should be working to reauthorize and strengthen the NFIP. Mr. Webble, can you speak to the consumer benefits of a long-term NFIP reauthorization?
I mean, in general, the insurance markets work better when they're long-term. They're long-term products. People in people's houses are long-term products. So I don't think there's any question that markets work better. Thank you.
Can you also explain to us in detail what the impacts of a government shutdown would be on marginalized communities that rely on the NFIP?
The shutdown basically kind of does two things in a sense that what's happened is the authorization of the NFIP is technically legally separate from a shutdown, but the authorization has been riding on the appropriations bills. So if an appropriations bill or some other bill that does not reauthorize the NFIP, if that is not passed by November 17th, what you have is the authority to issue new flood insurance would go away, and the borrowing limit would decrease from more than $30 billion to $1 billion. What that largely means is that people that need to get new flood insurance contracts that are buying new houses and the like would not be able to from the NFIP. They would have to go to the private market.
Thank you, Mr. Webble. And if a lapse in the NFIP brought on by a government shutdown wasn't enough, my Republican colleagues are also trying to eliminate the Federal Insurance Office, which, among other duties, is tasked with identifying gaps in insurance regulation that pose a systemic risk to the market and monitoring the availability of affordable insurance for marginalized communities. In fact, the Financial Services and General Government Appropriations Bill that we're going to be considering on the floor just next week, it zeroes out funding for this office entirely. I've submitted an amendment to reinstate funding for the FIO because personally, I believe we should be identifying the systemic risk to the insurance market posed by climate change and ensuring that marginalized communities have access to affordable insurance. Mr. Webble, can you explain some of the impacts of eliminating the FIO? And I think I'm out of time, but I would love to have answers to that for the record.
The
you,
gentleman's
Mr.
time
Chairman.
has in fact expired, and the gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm glad my colleague got all of her talking points in. The only thing she forgot to mention was Trump, guns, and abortion, and maybe some anti-Israel bigotry for good measure. Historic storms outside of the 100 and 500-year timelines have rocked communities across the country. Earlier this year, my district experienced devastating floods in the Hudson Valley. Communities hit by natural disasters like hurricanes, wildfires, and floods, and climate change are also confronted by the skyrocketing costs of repairs and rehabilitation for properties. And this is only compounded by the day-to-day inflation spurred by the reckless spending policies of the Biden administration and the hangover of the COVID economy. Can you describe the challenges that disaster-prone communities face in rebuilding such? I'm sorry, excuse me, it's my time. Thank you so much.
Will order. The gentleman's time from New York is there. It is the gentleman's time.
Thank you.
He's recognized.
Can you describe the challenges that disaster-prone communities face in rebuilding, such as the demand for materials and labor as part of the construction supply chain? And how do you factor these into premiums paid by consumers? To the panel.
Congressman, I'll just note that while there's some variation among states because of higher taxes in some states, cost of living, but the insurance cost inflation inputs of repairing cars, buildings, people have escalated very significantly. For example, from the beginning of 2020 through the first half of this year, construction materials have increased 35.5%, construction trade services have increased 30%, and the overall building replacement costs have increased nearly 45% over the last 5 years. So very, very significant increases in rebuilding costs.
So inflation has a tremendous impact on premiums.
That's correct. It's a primary cost driver.
Following up on that, as you know, the National Flood Insurance Program faces authorization hurdles at least once every year. Mr. Gordon, your members serve as write your owns with the National Flood Insurance Program. How does this uncertainty impact your business given the prep work needed to halt and restart a business?
It's very problematic, all the starts and stops and trying to retroactively fix everything. Every time there's a short-term lapse, it always creates additional costs, additional uncertainty. So we would support a long-term reauthorization of the program.
Mr. Gordon, many cities in America are facing spikes in crime driven by a number of factors, including the COVID-19 pandemic and prolonged lockdowns, depolicing efforts and the lax prosecution of certain crimes, permissive drug use policies, and an increase in drug abuse, and the empty streets created by employees not returning to their offices. According to the Council on Criminal Justice, there were 33.4% more motor vehicle thefts during the first half of 2023 compared to the same period last year. Property thefts also saw a marked increase last year after declining for decades. Mr. Gordon, do policies that encourage more crime in our nation's cities make property insurance more or less expensive?
Motor vehicle theft, and in particular catalytic converter theft, have been skyrocketing, and that's very much another cost driver for auto insurance. On the commercial side, increasing retail theft and crime is creating coverage friction. We've had a lot of discussions with our members earlier this year about some of the commercial insurance trends. We don't see an availability problem at this time, but the coverages have gotten tighter and more expensive, and there's concern not only about the theft losses, and there's a little disagreement over the intensity of that, but the accompanying risk of violence can trigger much more expensive liability lawsuits when people get injured. So this is a potential trouble spot we're concerned about and monitoring, and if there's not adequate insurance, not only are some of the businesses going to be put at risk, but some of them will have a hard time obtaining financing, which is already a problem for commercial real estate.
Have you seen a lack of willingness to insure commercial properties in high-crime urban areas?
So again, we haven't seen availability concerns, but there is some tightening of the coverage, and it is getting more expensive.
And what is the impact of crime on investment and development in our cities if properties become uninsurable?
It's going to put a lot of businesses at risk, and again, it's going to undermine the ability of those businesses to get financing. So it's a critical need.
The gentleman's time has expired. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Chairman. Just to be clear, we are talking about the cost of insurance going up. Is that auto, flood, property? I just want to clear up what this.
The focus of the hearing is on property and casualty insurance, but, to be fair, one of the underlying factors to that is flood. It's been referenced multiple times.
Okay, thank you, Chairman. Thank you all so much for being here. One of the things that I was hoping to talk to Mr. Weibel specifically, some of the factors that the insurance industry uses to me are sometimes factors I'm not sure what they're taking, usually it's the cost of the property, right? The value of it, maybe some of the other circumstances, in regards to, it could be theft and things like that. Are some of the factors, for instance, what my residents tell me about home insurance, they ask things that are what people are confused about is like the use of credit score to calculate insurance. Is that a practice that's increasing within the insurance industry that is rising the cost of insurance on people that might be working class?
I don't know that credit score use is increasing. Mr. Gordon might know whether the companies are using them more or less, but that is a factor that is used. That is a factor that generally is overseen by the state regulators that need to approve the factors that are being used.
Yeah, no, I see it in the auto industry a lot where non-driving factors like marital status and education level and people's credit score is weighed on top of it. And I'll give you an example. The University of Michigan did a study showing specifically that somebody with the DUI, drinking under the influence, was paying 3 times less in auto insurance rate, his insurance rate, versus somebody that had no DUI but had a lower credit score was paying, again, 3 times more, even though that person has a DUI. I'm looking at Mr. Gordon. You have something to say about that?
Yes, Congressman, we have some studies we did recently that we'd be happy to provide you that show there's actually a very direct correlation between credit score and driving behavior.
So somebody poor is not a great driver.
People who are poor do not necessarily have
They don't have
lower
access to
scores.
credit. They pay more.
No, there are lots of poor
So what's the
people who have very good
correlation
credit
between
scores.
somebody with the lower credit score, and listen, this impacts all of our districts. Somebody with a lower credit score, how is that a factor in how much their car is valued, how far they drive? The type of car. I mean, I'm being serious here. Why does a credit score have to be weighed towards the cost of insurance?
Yeah, very good questions, and again, we happy to give you some of our recent studies showing now that we have telematics, so we've actually monitoring direct individual driving behavior. There's a very high correlation between people who have lower credit scores, and there are lots of people who are wealthy with bad credit scores and poor people with good ones.
Yeah, but a guy with DUI with a higher credit score is paying 3 times.
Very strong correlation
Less.
between lower credit scores and hard braking and hard acceleration, which are shown by telematics to cause more frequent,
And
more
Mr.
severe
Gordon,
accidents.
you talked about scrap. Let me tell you, we looked in the state, in the scrap metal industry, which a lot of my colleagues actually benefit from. They're a special interest group, very strong in each state. If we got rid of cash transactions with catalytic converters in some of the scrap industry, because it's really hard for our law enforcement and others to track them down, why aren't we moving towards getting rid of direct cash transactions in the scrap metal industry?
So I don't know the details on that, but I will tell you this is an area for optimism that a lot of the states are making
finally.
changes on catalytic
I
converters.
was trying to get my state to do it.
Yeah, it's making a big difference, and we encourage the states to do more. We're finally seeing some light at the end of the tunnel and slowing of that catalytic converter theft.
Yeah. Ms. Lewis, it has been something of a huge issue in the state of Michigan. I mean, I saw alone in my district in Western Wayne, in particular Dearborn and some other areas, there's high amounts of flooding. I mean, sewage just coming out of people's basements. And it is because we had record rainfall. And so, much of my local mayors, I mean, these folks are different political backgrounds, are saying we should start looking at some of those risks and looking at how we support communities, especially working class communities that literally cannot subsidize for the climate risk that, again, the climate crisis that we're living in. Can you talk about the fact that climate risk?
Definitely. I am a personal victim of that. In 2022 in December, my basement was flooded with 5 feet of sewage and untreated stormwater due to rain. Not a flood, but rain.
Yeah.
My insurance company declined the coverage because I didn't have sewage backup coverage, which I didn't know I needed. I was technically homeless for 7 months.
I'm so sorry you went through that, but this is like real life impact. And Mr. Chair, I would love to have more conversations about the use of various factors like marital status, education level, credit score, in calculating insurance rates in our country.
I think the gentlewoman from Texas, Ms. De La Cruz, is now recognized for 5 minutes.
Yes, thank you, Mr. Chairman, for holding today's hearing. Insurance and financial services is something near and dear to my heart as I've spent over 20 years in this industry. So I actually understand, because I've worked in that industry and owned an insurance agency, how marital status, credit reporting do affect and can be a factor in what people pay for their insurance costs. That being said, in the county of Hidalgo, where it is 90% Hispanic, we see varied rates, insurance prices based on risk. And let's just go to the mere definition of insurance. Mr. Gordon, tell us, what is the definition of insurance?
Well, insurance is, again, ultimately providing protection for individuals, protecting them from risk.
So if there is a higher risk, then that means that there is higher premium, correct?
That's correct. And in fact, every single state prohibits insurance from being unfairly discriminatory, and insurers are closely examined on that. And what unfairly discriminatory has always meant is when you don't charge based on the risk. So insurers are required to based on individual risk.
So it's not based on your ethnicity, it's based on your risk.
Correct.
Okay, so what we keep hearing over and over again that is been alluded to was that it is based on ethnicity. If you are of a minority, in my case, 90% Hispanic, then you just have higher premiums. Would that be a correct statement?
No, and the regulators would never allow that. We've actually published very extensive studies that we've presented to the regulators on this, examining years of data on auto insurance showing that there's no unfair discrimination. In fact, it really boils down to place, not race. When you have urban areas with high traffic density, you have more accidents. There may be some historical racism that has led to minority groups disproportionately living in those urban areas, but when you control for the vehicle density, the urban areas, most of that disappears. And again, we're heavily regulated by the states on this issue, and we've shown reams of data showing that those neighborhoods are not being charged more for their risk. It's not a racial issue. We're not allowed to use race as a rating factor.
Wow. So what I'm hearing is that ethnicity has nothing to do with the rates, that it is about place, not race.
Correct.
And what I would like to know is that because it's about place, not race, that means if you live in an area where there is high uninsured vehicles, then you're probably going to pay more for your car insurance than in a place that is different.
Correct.
So in Hidalgo County, we are, again, 90% Hispanic, and we have a large population or large automobile owners that come from Mexico that do not have insurance. Thus, it's not because we're Hispanic that we pay more, it's because there are a high number of vehicles on the roads that do not have insurance. Would that be a fair assessment?
Yes, that's fair. It's accurate. And also, I'd note the Texas regulators are also very, very robust regulators, keeping an eye on that.
So would you say regulators, state level and federal, state level regulators, correct? And would you say that the state regulators take pride in their job and do a thorough job?
Yes.
So they take pride in making sure that the state laws are being abided by.
Yes.
And so those same state regulators would make sure that insurance was based on risk and not ethnicity.
Correct.
Thank you. I yield back.
Just, Congresswoman, if I may, and this is something the state regulators are working on extensively with us. I think Commissioner Arnold noted they're working on guidance on AI. We've been having extensive conversations as an industry with the regulators on testing. So there is a lot of oversight and work in this area.
The gentlewoman's time has been yielded back. The gentlewoman from Colorado, Ms. Pedersen, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here today. I really appreciate your time and expertise. Ms. Lewis, I wanted to know if you'd like to add anything to the previous line of questioning. I know you have a lot of experience around underwriting and that process around race as a factor in premium costs.
Yes, I would like to add, I have never seen a situation, nor have I had my friends who are underwriters not talk about race being a factor when it comes to insurance. And I'm just very, very concerned with anyone who would think that race is not a factor, because we all know that race is a factor. The insurance industry, you have underwriters, you have loss control people who are the inspectors, and these people go out and openly talk about those people and how they're not going to be insured or how they're going to pay more. The underwriter subjectively debits and increases the cost of their insurance just because of who they are. I'm also very concerned about credit being used to determine insurance rates, because that is not a factor. Credit doesn't determine whether or not I'm going to get into an accident. Credit doesn't determine how I drive. Well, what does determine a lot in urban areas is those people who live in the suburbs who drive to the city every single day to come to work. Nobody thinks about those statistics, and I would like to have someone tell me, provide a study about all those cars that come into the urban areas. Because even though people who do drive cars in urban areas, most people in urban areas take public transit. Thank you.
Thank you for highlighting that today. I had no idea that this was a factor in actually being insured, so really appreciate that. Look forward to following up on that. This is a very important hearing for my state, a critical issue for Colorado. We don't even have a wildfire season anymore. With the changing climate, we are constantly under threat of wildfires. In communities throughout my district, I have people that are reaching out that unfortunately are unable to buy homes because they can't prove that they're able to be insured. We have insurance companies pulling out of markets because the risk is so unpredictable. And so I guess more broadly, there are so many, when I met with people representing insurance companies recently, they talked about right now we're facing kind of a perfect storm. We went through the pandemic. We had the economic fallout because of the pandemic. Supply chain was decimated. We had inflation and rising costs, and one of the biggest factors in that is our workforce and inability to hire, which of course that affects all of us, especially in the construction industry. Everywhere that I go, no matter who I'm talking to, even if it's insurance representatives, we talk about legal pathways and how critical that is to addressing the workforce shortage for our current need, let alone the future needs of our country. We're also facing increased risk because of the climate crisis, and that absolutely affects Colorado. And so when I think about how complicated our current situation is, but what's going to be happening in the future if we don't work together to address and help support communities like mine, I just want to broadly talk about what we should be thinking about in Congress, and now I'm almost out of time already, about how to address this issue, how to use AI to build more sustainable, resilient communities, and development recommendations, and how we work together to take what we've learned around flood insurance to bring wildfire insurance to help support communities, but also learning from the lessons of things that have gone wrong there. So I know I'm almost out of time, but if anyone would like to comment.
Congresswoman, if I may, just because you touched on one of my favorite passions, which is how important AI is going to be to help us solve some of those workforce constraints you're talking about. With fewer and fewer people in the workforce trending over time, the only solution for our industry is to use AI, for example, drones after disaster hits to more efficiently and quickly find out where the damages have occurred. Now, a lot of companies, you can use your iPhone to take a picture of your auto accident and send that in, and the AI will quickly determine which group of humans needs to make a final decision, but it helps triage that. We are not going to have enough labor in the future for our insurance needs if we don't leverage AI with appropriate regulator supervision, of course.
Great. Look forward to a longer conversation soon.
The gentlewoman from Indiana, Ms. Houchin, is now recognized for 5 minutes.
Thank you, Chairman Davidson and Ranking Member Cleaver. Thanks you to the witnesses for your testimony. As you're all well aware, the insurance industry impacts all Americans, regardless of income, location, stage in life, from first-time home buyers who want to feel secure in their purchase to empty nesters saving for retirement to retirees. Americans want options that provide the protection they need while also being affordable and within their means. Under recent stresses and the rise of inflation, it's become significantly more difficult throughout the country, including in my district. Recent surveys have found employers and workers have seen health insurance costs jump 7% in the last year, car insurance costs an average of 17% increase nationwide, homeowners insurance up 21%. With inflation taking a toll on Americans' pocketbooks in all sectors, increases in insurance costs have become particularly extreme. So thank you for coming to talk to us today about this topic. We know the problem. I would like to focus my limited time on what Congress can do or specifically should not do in response to rising costs. Mr. Gordon, you have emphasized the importance of better land use planning as a way to reduce the risk and impact of natural disasters such as floods, wildfires, hurricanes, and earthquakes on the property and casualty insurance industry. I also understand the current land use planning practices in the United States are often inadequate, inconsistent, and ineffective, and have led my constituents in Indiana to effectively subsidize those who build dangerously on the coasts. Could you expand on why land use planning is so crucial for the resilience and sustainability of the insurance sector and the communities it serves? And could you explain why we've gotten it so wrong up till this point?
What we've now seen is the number one cost driver for the insurance rates has been people moving into high climate risk regions. And sometimes some of the government policies not only subsidize that, but ultimately they mask the true environmental costs. I think my colleague, Mr. Nutter, mentioned that we've seen a roughly annual 5 to 7% annual increase in natural disaster losses, largely because of those movements. We're not taking into account when people buy a home, what is the long-term cost going to be of insurance living in a coastal area, living in the wild land-urban interface. And then we're not doing the land use management, things like controlled burns like we used to do as a society to make sure we don't have more and more wildfires. And we're just now developing, and this is really one of the most exciting parts of the industry, some very new fire safety standards, how you build defensive space around your house, and you need communities to do that to protect each other. So there's a lot of work in this area, and there's a lot of opportunity for policymakers to get better building codes, get better land use management, get better mitigation into society.
Thank you. And I want to focus specifically on subsidies as a means to address the issue of rising insurance costs. You discuss in your written testimony the death spiral that subsidies can create in markets. Do subsidies cause rates to increase to ratepayers? Could that in turn result in more individuals needing to access a subsidy until a private market is replaced almost entirely by a public or largely subsidized market at a higher and higher cost to other ratepayers? Is this the death spiral that you discuss?
That's exactly the death spiral. And in fact, we saw this in Florida after Hurricane Andrew. They tried rate suppression, and you went from the vast majority of 94% of the homeowners' policies were written by national insurers to, after several years, only 18%. So think of how many national carriers abandoned Florida because of the rate suppression. That's what we're seeing in California. California also has a residual market that says all those people who aren't getting coverage in the admitted market, they go to the residual market, but the excess losses have to get paid back by the insurers with no recourse. And so it's like the musical chairs where there are fewer and fewer insurers left holding a bigger and bigger bag of exposures.
Thank you. And Mr. Nutter, you talk about what Congress should not do. I appreciate that you clearly state Congress should not create a new federal property reinsurance program to displace the role of states. I agree. Can you discuss why it's so important that Congress not create a new program?
Thank you for the question. Effectively, it would put Congress in the business of regulating or managing property markets at the state level, where in fact you have very different state perils, legal environment, regulatory philosophy, that it really is going to be a counterproductive, if you will, and it concentrates risk that taxpayers across the country will subsidize high-risk people from low-risk areas.
Thank you. I yield back.
Thank you. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you. Good afternoon, and thank you to the chairman and ranking member. I'm glad that we're finally getting back to work here in the House, and I appreciate our witnesses for taking the time to be here. We're here to discuss an issue that is undoubtedly important, and I certainly agree that we should take a serious look at solutions to mitigate the alarming increases recently in insurance costs. However, based on the legislation noticed for this hearing, I believe that we should be focused on dealing with the concurrent and interconnected crises that face our Congress today instead of spending our time debating the existence of the Federal Insurance Office. My constituents deserve to have a Congress that works for them, and right now they are desperate for solutions to the affordable housing crisis that is gripping our state and the nation. During a time of continued elevated housing costs, with the average household spending over 30% of their income on mortgage or rent, and a shortage of nearly 6.5 million homes, the ability to make ends meet and keep a roof over their heads is slipping away from countless families across the country. And yet, we cannot advance any meaningful housing policy because we still have had 0 hearings on affordable housing in this committee, this Congress. Now that the floor has finally been reopened for legislative business and we're finally able to get back to doing the people's work, I hope that this subcommittee, the Subcommittee on Housing, will adopt a renewed focus on how we can promote sustainable and affordable housing for everyone. All of this chaos must be considered within context, and unfortunately, due to the complete paralysis that this House found itself in, we now have only 15 days to avert a needless government shutdown. Given what we face as a nation, a shutdown at this time should not even be an option, and yet we are quickly running out of time to avert yet another crisis. We've continued to see depressed home sale volume this year, and my colleagues' inability to provide long-term funding for our government agencies will only exacerbate this issue in the communities that cannot afford to lose financing or pay fees to push back their closing. If we want to examine factors in the high cost of insurance, then we must seriously consider that in the event of a shutdown, property owners could be subject to force-placed insurance policies by their mortgage services, which has historically been even more costly than insurance obtained in the marketplace. Ms. Lewis, unfortunately, we know that these impacts will not be borne equitably across socioeconomic lines, and that communities of color will inevitably be hit the hardest. Could you explain briefly to the longer-term impacts that even a short-term shutdown could have on low and medium-income communities that depend on the National Flood Insurance Program?
I'll try to explain. I'm sorry for my hoarseness. Even a short-term delay would affect low-income communities and communities of color because they don't have the reserves to sustain them if they don't get immediate relief. And that's a serious problem that's pervasive throughout the entire community.
Thank you. Not only the impacts of a catastrophic lapse, but also the underlying cost will not fall on all of our communities equally. This, unfortunately, remains true for the challenges associated with the ever-present effects of climate change. While this may be difficult for some of my colleagues to admit, we can no longer ignore the increasing frequency and severity of natural disasters. As you may have heard, in a normal year between 1980 to 2022, the United States is expected to face approximately 8 disasters with losses exceeding $1 billion. We've already been struck by 24 such disasters thus far in 2023 alone, totaling over $67 billion of combined losses. So, Ms. Lewis, as we continue to see rising insurance rates in light of the increased risk of natural disaster events, federal programs focused on mitigation are also important. So can you explain the impact to constituents in this regard?
Oh, definitely it's important. I think at the end of the day, the first thing we should do is eliminate the risk. You know, stop constructing houses and schools in flood zones. Make sure that building codes are up to the standards where they can withstand hurricanes and floods. We aren't doing that, and we need to do that.
The gentleman's
That's
time has
just two
expired.
examples.
Thank you for your response. I yield back.
The gentlewoman from California, Mrs. Kim, is now recognized for 5 minutes.
Thank you, Chairman Davidson, for letting me weigh in to this very timely and important hearing. And I want to thank our witnesses for being with us today. I represent California. Unfortunately, in my home state of California, there are misguided policies from Sacramento and the state's insurance commissioners. Due to those, they have recently forced major insurers to exit the California insurance market. As a result, my office has received numerous phone calls, messages saying that the cost of insuring homes is simply unbearable and unaffordable. The less competition and less players in the insurance market is pushing premiums go up and forcing people into California's FAIR Plan, which is more costly than private plans and does not provide comprehensive coverage. Mr. Gordon, I want to ask you, you know about California Insurance Commissioner Lara. He said recently that he will continue to partner with all those who want to work toward real solutions. And so with that, can you update the committee on any new agreements made between State of California and stakeholders since Mr. Lara's announcement regarding policy changes to state insurance policy?
There was a very strong effort by the California legislature to create some fixes. Those fell apart at the last minute as their effort to add more mandates and prohibitions on non-renewals. A lot of the problems, frankly, are created at the regulatory levels. I mentioned going 30 months without approving a single private passenger auto rate increase at a time of record inflation. So I think the governor and the commissioner now recognize there needs to be fixes. They've both committed to doing it. Although some of those fixes are going to take a while, they're targeting the end of 2024 to get some of those new improved regulations in place, meaning they would take effect in 2025. That's a long time in a deteriorating marketplace to get fixes in place.
Yeah, you were talking about the 35-year-old regulatory framework, right? Obviously, we agree it needs to be acted upon and upgraded, so that, because my fear is that since it's taking too long, even though Commissioner Lara is saying all these policy recommendations, the next state commissioner could rescind policy changes. So we do agree that there needs to be a legislative fix. But another problem that we're seeing in the state of California is the broken FAIR Plan, which, as you mentioned in your testimony, already has a large deficit. So can you describe the FAIR Plan's assessment process and how it ultimately increases prices for households who buy insurance in the private market?
Yeah, the FAIR Plan is horribly underfunded, as most government programs ultimately tend to be, particularly for insurance. And insurers are, any excess losses that the FAIR Plan has, there's a whole layer of assessment that go to private insurers, and they're not allowed any mechanism to recoup that. That was something in the legislative process they knew needs to be fixed. And so what that means is, if there's a big wildfire in California, and a lot of the wildfire most high-risk areas are areas with a disproportionate concentration of FAIR Plan policyholders, that means the private insurers who haven't withdrawn from the market are going to get left with that bigger and bigger tab. And so that's spreading those costs because insurers have to make sure they're collecting enough money to cover all of those additional expected liabilities and exposure. So those who are staying in California have to collect more and more for that exposure. That is a ticking time bomb that I know the legislature and the commissioner are hoping to fix.
Thank you for mentioning that because, again, I represent a community that is very wildfire prone and we need to do something about it. So obviously, California needs to do something more to mitigate those wildfires and with the active management tools. So thank you for mentioning that. Mr. Nutter, you said something very interesting in your oral statement, that insurers are not required to buy reinsurance, yet they do it. So why do they do it? And how is California's Prop 103 impacting the reinsurance market that we talked about?
Yes, thank you for the question. They buy reinsurance largely to manage where they have a significant concentration of a peril, in your case wildfire, or where the capital support for the company is enhanced by the role reinsurance plays. The issue that I'd highlight for Prop 103 that you're referring to is largely that it has caused the insurance department not to take into consideration the future risk associated with that, and to look at solutions, perhaps community-based solutions, that would find both mitigation and financial recovery as part of that.
Thank you. My time's up. Thank you.
Time has expired. Since it is probably his last appearance before our committee, I did want to take a moment to acknowledge that Frank Nutter will be retiring from RAA on December 31st after 32 years as its president. During his tenure, RAA has grown into the leading voice for the reinsurance industry in the United States, and that's quite an accomplishment for anyone from his humble beginnings in West Virginia in particular. But it's not even his most important contribution. Before he came to RAA, Frank was also an officer in the United States Navy, served in Vietnam. Thank you, sir. We applaud you for your service to our country and for your leadership at RAA. We wish you well in your well-earned retirement.
Mr. Chairman, thank you so much for that. It has always been an honor to appear before the committee today and so many other times, and an honor to represent this industry. Thank you.
Thank you. I'd like to thank all of our witnesses for their testimony today, and without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their responses. I ask our witnesses to please respond as promptly as you're able. This hearing is now adjourned.